In a surprising turn of events, the Bank of England has cut its key interest rate for the first time since the pandemic, marking a significant shift in the global economic landscape. This decision, motivated by a drop in the UK's inflation to 2%, stands in stark contrast to the U.S. Federal Reserve's ongoing deliberations on whether to scale back rates. As the global economic scene recalibrates, with central banks like those in Europe and Canada following similar paths, the implications for the U.S. economy become increasingly profound. A stronger U.S. dollar, a potential consequence of these rate cuts, could mean cheaper imports, but also challenges for exporters and multinational companies. How do these shifts in interest rates by central banks overseas ripple through to impact the U.S. economy? What does this mean for everyday consumers, businesses, and investors? As we delve into the mechanics of these economic decisions, we invite you to ponder the interconnectedness of our global financial system and how actions taken across the ocean can influence our economic realities. How a rate cut by the Bank of England could influence the U.S. economy. In a world where economies are intricately linked, decisions made by central banks in one country can have ripple effects globally. Recently, the Bank of England lowered its key interest rate for the first time since the pandemic, a move that could have significant implications for the U.S. economy. This article explores the reasons behind the Bank of England's decision, the potential consequences for the global economy, and how these changes could influence the USA. The Bank of England's decision. On Thursday, the Bank of England reduced its key interest rate by a quarter percentage point to 5%. This decision came after inflation in the UK fell to the central bank's target of 2% in May and June. This move aligns with similar actions taken by the European Central Bank and the Bank of Canada, highlighting a global trend towards lowering interest rates as inflationary pressures ease. The UK economy, which nearly slipped into recession in 2023, has shown signs of recovery this year. Economists at Wells Fargo predict that the UK's gross domestic product, GDP, will grow by about 1% this year. Despite this recovery, the Bank of England noted that the restrictive stance of its monetary policy continues to weigh on real economic activity, leading to a looser labor market and reduced inflationary pressures. Global trend towards rate cuts. The Bank of England's decision is part of a broader trend among major central banks. As the U.S. Federal Reserve raised interest rates to combat high inflation, other G7 economies followed suit, partly to stay in line with the Federal Reserve. However, with economic growth slowing, more central banks are now opting to cut rates. The European Central Bank and the Bank of Canada have also recently lowered their rates, reflecting a shift in global monetary policy as inflation becomes more controlled. Impact on the U.S. economy. The changes in interest rates by central banks abroad have a direct impact on the U.S. economy, primarily through the effect on the value of the U.S. dollar. Currently, the U.S. federal funds rate is set between 5.25% and 5.5%, making U.S. bonds more attractive to investors. This increased demand for U.S. bonds can strengthen the dollar compared to other currencies like the British pound and the euro. In the immediate aftermath of the Bank of England's decision, both the British pound GBP USD and the euro EUR USD weakened against the dollar. A stronger dollar has mixed implications for the U.S. economy. On one hand, it benefits travelers and importers by making foreign goods and services cheaper. On the other hand, it can negatively affect exporters and multinational companies like McDonald's, which have significant operations abroad, by making their products more expensive in foreign markets. Investor behavior and inflationary pressures. As interest rates decline in Europe, investors may prefer to keep their money in the U.S. to achieve higher returns. This shift can further boost the value of the dollar while putting downward pressure on the euro. According to Jumana Sailheen, Vanguard's chief economist for Europe, this dynamic can increase inflationary pressures in Europe, partially offsetting the benefits of rate cuts intended to stimulate economic activity. However, moving ahead of the U.S. Federal Reserve in terms of interest rate cuts carries its risks. Roger Eliaga Diaz, Vanguard's chief economist for the Americas region, notes that other central banks typically take cues from the Federal Reserve due to the significant impact of U.S. dollar flows on the stability of local currencies. This interdependence highlights the delicate balance central banks must maintain in coordinating their monetary policies. Broader economic implications. The decision by the Bank of England to cut interest rates reflects broader economic trends and challenges that central banks worldwide are facing. With inflation becoming more controlled, central banks are shifting their focus towards supporting economic growth. This involves carefully adjusting interest rates to stimulate investment and spending without triggering excessive inflation. In the UK, the rate cut aims to support economic recovery following a period of near recession. By lowering borrowing costs, the Bank of England hopes to encourage businesses and consumers to spend and invest more, thereby boosting economic activity. Similar motivations underpin the rate cuts by the European Central Bank and the Bank of Canada. As central banks around the world adjust their interest rates, the interconnected nature of the global economy means that these decisions have far-reaching implications. The Bank of England's recent rate cut, in particular, highlights the delicate balance central banks must strike in managing inflation and supporting economic growth. For the U.S. economy, a stronger dollar resulting from these rate cuts can have mixed effects, benefiting some sectors while posing challenges for others. What are your thoughts on the global interconnectedness of our economies? How do you think these interest rate changes will affect your daily life and the broader economic landscape? Share your opinions and join the conversation on this critical topic.